our next panel, and for this one, our guests will be talking about breaking down DeFi lending. So we have Ayesha from MNNC Group, Charles from DYDX, Kirk from Morpho, Dion from Term Labs, and Alex from, AppShift. All right, there you go.
Thanks, guys. So I'm not going to be the party pooper on DeFi because the honest truth that it's one of the only functional element for Ethereum. And I was a very early team member at Consensus, so I take a pride in saying this. So here we have like experts that, you know, as a fund, we like love working with, and we've seen growth early in the industry. And I like how DeFi gets its own little private room because the alpha we're about to share. So for quick background, I work at MNNC Group. We're a multi-strat hedge fund. Previously, we were known as Ledger Prime. And I also teach at NYU, blockchain and DLT. I run a research lab there. A lot of my research has been focusing on Ethereum for past 3 years or so. And I just wanted to quickly introduce my panelists, and then we'll take it from there.
Hi everyone, I'm Kirk. I'm the governance lead at Morpho, which is a immutable lending platform that's on Ethereum and Base, and coming soon to an EVM network near you. So I'm herding the cats in the governance forum and running the cross-chain growth strategy, so we can talk a little bit about that on the panel, I hope.
Hello everyone, my name is Charles. I'm with the DYDX Foundation. DYDX is a DeFi protocol. We've been in the business since 2018. We focus on perps, which is one of the largest markets in crypto. And we migrated 1.5 years ago or so from Ethereum to our own app chain on Cosmos. And last year, to give you an order of magnitude of the size of the protocol, we moved about $270 billion of trading volume. So well established and very, very much focusing as well on lending because it enables our users further.
Hi everyone, my name is Dion Chu, CEO of Term Labs, and we're a DeFi lending protocol, allows you to borrow and lend against your crypto assets on Ethereum at a fixed interest rate.
Hey everyone, I'm Alexandre. I'm the co-founder of UpShift. UpShift is a soon-to-be-announced yield tokenization protocol that is running vaults and enabling other partner protocols to run yield strategies curated by managers, similar to some other panelists here. UpShift is built on the August stack. August is a wallet infrastructure currently built for institutions that governs the way all of these strategists and curators are managed. August processed about 7 billion in transacted volume in December, yeah, we're excited to go public soon.
So Alex, I'll start from you, right? Like, let's come this way. How do you think, and how has DeFi moved to manage accounts? You brought this up. It's a pretty interesting concept. Prior to this, there was a talk about how DeFi is like not really MetaMask anymore, and then how would you say that you've seen that grow towards managed accounts?
Yeah, so I think I'm not the only one here. Like, there are vaults on Morpho, there are vaults coming to Term, there are vaults on DYDX. DeFi has become more professionalized. It used to be that you could just put your stablecoins on SushiSwap and earn a gazillion % APR, right? These days are over, and I think first question is, where does the yield come from? There's token rewards, trading fees on AMMs, and demand for leverage in the form of perp funding. And all of these things have become harder to manage as the space has become more and more professionalized. UniV3 is way harder to manage than UniV2. Funding arbitrage and funding strategies are moving around all the time. And so for users, and that it's just become easier to package all of these things into professionally managed vaults. And so it completely abstracts away the complexity from users, and that's generally the trend that finance has always taken. Technology is just bundling and unbundling and repeating the cycle. The first wave of DeFi unbundled everything and made the user experience pretty hard for the average user, and so it seems like the trend is going towards repackaging that in things that are easier to use.
Dion, do you want to add on how the investor base has become more sophisticated? Like now we see it like more funds or more sophisticated investors or high net worth, other than just every other, retail investor?
Yeah, for sure. I think that the Ethereum DeFi ecosystem has really matured in the last few years since the last cycle. You know, as Alex mentioned earlier, the earliest version of Uniswap was a simple pool, you know, two-sided liquidity, not the most efficient, a lot of impermanent loss, but it worked because it was the early days, everybody was still experimenting. And over time, you see on-chain a lot more institutions getting involved. Just as a point of reference, if you look at Aave, the top 1% of users account for 50% of TVL. This is a $30 billion protocol. So something like 200 to 400 users, you know, are controlling like 15 billion on Aave alone. So you see that, especially lending protocols, it does tend to be much more sophisticated, institutional type of users. You think about retail users, they're not looking to earn 5 to 10%. You know, they want to trade meme coins, they want to get a lottery ticket, make 10x, 100x. So it's just a very different user base, and with the growth of lending protocols on chain, that really is a reflection of growing institutional user base.
Charles, do you want to add like how all of this like borrowing and lend is translating like or transferring to you at DYDX, right? Like because it's the same pool of family at the end of the day.
Yeah, absolutely. We are able to kind of trace a little bit where are the USDCs. So the collateral you use when you trade on DYDX is USDCs. So we are able to trace a little bit where are these USDCs coming from, and a portion of it is coming from lending protocols. So it's very interesting to see how essentially, even though we are our own chain, and it's our own ecosystem, just people will bring liquidity from, should it be Ethereum or Layer 2s or Solana. So it's an interesting way to get additional flow within DYDX, and we can trace that. One thing we're exploring as well, and it's probably kind of building on what you were saying just earlier, we launched at DYDX our own systematic liquidity provision system. Essentially, it's an automatic traders on DYDX. So we have about 180 different trading pairs, and it's not possible for the protocol to get like market making agreements for all of this. And sometimes some of those markets are not organically liquid. So we launched this liquidity system called the Mega Vault, where essentially a portion of the protocol fees are distributed into this Mega Vault to provide liquidity. But the size of this Mega Vault went very, very big very quickly. This Mega Vault is operated by a third-party operator called Gotlet. I think it's a name familiar in the DeFi ecosystem. And what we're exploring also right now is effectively the Mega Vault varies between 50 million to 80 millions. Not everything can be deployed. So there is an avenue of research right now looking at how this essentially pool of liquidity within the protocol can be lended back to some traders at the protocol level itself. So we are very much exploring to give as much optionalities for traders, mostly institutionals, to get access to liquidity and deploy it within DYDX. So lending can come from lending protocol, but it can come also when you have the resources and the engineering available to basically bring liquidity from your protocol to your own users, which is something new for us.
Kirk, I wanted to talk to you about your integration with Coinbase, right? I think it's pretty big. Congrats. What does it mean, right? Like Coinbase, you know, they've been doing phenomenal work, but what does it mean for DeFi? And then how does it pull down, you know, on the pools level?
So at the end of the day, the vast majority of people in the world are never going to be like signing transactions and looking at call data, right? In order to bring crypto and its benefits to the world, we need to be able to go through various stages of less decentralized intermediaries in order to, you know, replace if you think about, you know, 100 million people with $1,000 in their checking account, how can we cut the margins of those banks and bring them into DeFi lending? And so what makes Morpho special is that it is not, you know, like Ava or Compound or Maker, a single pool with a single risk manager that's mutable. It's a platform that anyone can build on. And this immutable code base, which has the highest audit density per line of code of any in DeFi, gives big players like Coinbase the confidence to expose their users to it. You know, naturally, Coinbase is very hesitant to expose their users to DeFi risk. Like, we look at the Bybit hack, even a Gnosis safe, which is a trusted pillar of the ecosystem, can be vulnerable to front-end compromises. So Coinbase would be very hesitant to put user funds into any protocol that's upgradable. So this very lindy, non-upgradable code creates a foundation that Coinbase, and not only them, but in the future, TradFi players, banks, wealth managers can be confident integrating for their users with the knowledge that it will never change, no one can turn it off, they can fully customize their own risk exposure however they want. And so that's what we're really excited about at Morpho, is giving a toolkit, right? We have no opinions about risk, anyone can build whatever they want on it. Degen vaults with 25% APR, safe treasury-backed vaults with 5% APR, and really have a customized experience. And with our future products, we will intend to keep going down this path of making it more and more customizable and as simple as possible for people to integrate with.
Do you think, in an extension, and then please feel free to add on thoughts, because as Charles mentioned, I know Alex, you're working on it, and Term is probably also looking at, do you think other ecosystems can be as liquid as Ethereum?
As Ethereum, probably not anytime soon. But the way we see it is Morpho's relationships to all of these people who are building on top is similar to the relationship between Ethereum and the L2s. Ethereum does not preference or prioritize any L2. They provide this neutral base infrastructure that other people can build compelling businesses and diversified use cases on. And so that's what we'd like to see. And so, maybe Morpho on World Chain will never be close to as liquid as Morpho on Ethereum, but that's okay because it's a different user base, right? Like the DeFi whales on Ava who are managing $1 billion are going to want the strongest possible security guarantees on mainnet, but tens of millions of people who want to earn some savings on $100, $1,000 of their savings through the World app can be very happy there and served through this, different user-centric product that's primarily mobile app-centric that has minimal gas costs. So to me, it's not it's not only the most liquid network that's valuable, but what's valuable is multiple differentiated use cases that can expand how many users we can reach to eventually everyone in the world.
Maybe to build on that and to come back to your questions, will some other ecosystems be able to grow closer to the size of Ethereum? I think what Morpho illustrates is essentially new strategies in terms of distribution. I think all of us in the industry in DeFi, we can do a better job at distributing products. And if we look at how financial products are distributed in TradFi, they're distributed via B2B2C. If you want to buy a fund from BlackRock, it's very hard to get an account directly with BlackRock, right? You will get it from your broker or your bank. So what we spend a lot of time working on right now at the DYDX Foundation is looking at how we can essentially rethink the distribution of DYDX and DeFi products in general. And essentially, if you're looking for new users for DeFi protocols, you can try to kind of steal them from your peers within the on-chain business. But the next step is basically like the customers which are the most ready are coming from CeFi. And there is great conversations to have with the Binance, the Coinbase of the world, where essentially all those centralized exchanges are in a global race to acquire licenses. Most of those licenses are only for spot. So as soon as Binance or Coinbase get a license in a country, most of the time they have to stop lending with their customers. They have to stop futures. And what this big pool of customers behind these CeFi players, what they want to do, those exchanges, is essentially keeping the customers within their ecosystem. So they are all building the same strategies. They are all building wallets. The Coinbase wallet, the Binance wallet, and the list goes on. And it's I think, an opportunity for many DeFi protocols. Should you be in direct lending? Should you be in trading like we are? To essentially bring your products where the users are. And you will be surprised how the conversations are evolving. It's a little bit counterintuitive to think like, should I go and engage with CeFi to grow my DeFi project? But I think you should, and there is an alignment. You can do revenue share. I suppose you guys are doing revenue shares with Coinbase. I think we're going to see what Morpho very elegantly executed on, being replicated on many different other topics. Should it be for swaps, for perps, or many other topics? So the Web3 distribution, I think, is probably starting a new chapter. And the early movers in these strategies to bring products where the users are will pay off big time.
I would echo that as well. I think historically the space has had a lot of opinions about how to manage distribution and who the users are. We've taken a stance and to have obviously we have technical opinions and there are tech stacks we prefer and we prefer lower fees. But in general, we'll just go where the customers are, and different customer profiles live on different chains, different sizes of transactions have different security requirements. And if you look at the life cycle of liquidity, for all emerging protocols, it seems like the pattern that's emerging is, first you engage a bunch of, DeFi funds to provide largely mercenary capital to bootstrap your liquidity. Then you integrate with more DeFi traditional venues, your receipt tokens get listed elsewhere, you integrate your receipt token with the Morphos of the world, you allow a bunch of DeFi looping, etc. And then over time, you plug into the real organic distributions with, eventually the neobanks of the world, the C5 venues of the world. And, you're seeing it with Athena just wrapping their product into an SPV or an actual fund vehicle. And so fundamentally, we're building DeFi plumbing. And I think we have to be realistic about the fact that, in general, you don't distribute the plumbing. It's abstracted away between the user and like behind a layer of much more user-friendly interfaces.
Yeah, I think my view is, at least as far as EVM world goes, it's going to be very, very hard to unseat Ethereum L1 as a primary liquidity layer. If you think about it, a blockchain has network effects, just like social networks or something like Uber. And it's really hard for one person to unilaterally switch when everybody else is still, on the other system. So I couldn't start driving on the left side of the road if everybody's still driving the right side. I'm going to get run over. And every player has the same kind of thought process. When I'm launching a new protocol, do I want to go somewhere new, or can I go here where all the liquidity is and where all the business is? And so unless there's a concerted, coordinated move somewhere else, it's very hard to unseat that network effect. You do see it in social networks, like you have Facebook, copycats of Facebook won't work, but maybe you have something like Instagram or TikTok that offers something new, and then you can also build a network effect there. But EVM by definition is exactly the same. So how do you get some other EVM that's exact copy, L2 or another L1, that does the exact same thing as Ethereum, has the same limitations as Ethereum, to kind of take that liquidity? I just think it's very hard.
Great. Dion, I actually have a question for you. I wanted to, and Alex, feel free to anyone chime in. I wanted to talk to you about collateralized lending, right? We, at the fund, we've seen some C5 players blow up over the years, right? And obviously the argument was that, look, DeFi works, right? And then we see options on term, and then, on you guys, collateral and how important it is. And then the emergence of collateralized platforms coming back. Why is it, yes, it's important, but why does it so much matter now than, aside from what we've historically seen, the blown ups?
Yeah, I think the limitation of DeFi is also its strength. In DeFi, all of your counterparties are anonymous. The only thing you know is their public address. You have no idea who they are. So you can't sue them, and you can't chase them down. So it's very hard, near impossible, to do unsecured lending on-chain to somebody you don't know. So all lending to date on-chain has been collateralized. And collateralized lending is the most secure type of lending in TradFi. Obviously there are a lot of limitations to that. If you don't already have money, you can't borrow money. Only people who already have capital to begin with are able to access capital. But also because of that, all your loans are much more secure because there is something backing it. And worst case scenario, you can seize the collateral if there's bad debt. So when you hear about cycles of credit growth driving boom-bust cycles, leading to bad debt and financial crises, that's always coming from unsecured credit. But it's really hard to go over your skis if you always require real hard collateral behind a loan. And so because of that, DeFi lending has been very safe. All DeFi lending is backed by real and liquid collateral. And so you see when even with Bitcoin falls 90% peak to trough, the lending protocols are, are solvent. And that's not something you have in TradFi. It's just not possible. If you do unsecured debt, there will be people who can't pay. We'll see what happens over time, but so long as DeFi stays collateralized, then I think DeFi will be really safe. But there will be a lot of use cases that just won't be possible. I think the last thing I would mention along those lines is that, another key real strength of the blockchain is addressing counterparty risk. So in TradFi, you lend to somebody, lend to your bank or borrow from a bank. You're trusting that they're holding on to your collateral. And if they go under, you might lose your collateral. With a smart contract, you don't have to trust anything. The collateral stays there. There's no private keys. You can't hack a Gnosis safe. It's programmatically locked in the smart contract. So I think that is really, one key use case of the blockchain is removing that kind of middleman custodian role and turning it into a smart contract that, is super secure.
Alex, do you want to quickly add to it? I know you said you won't talk about your parent company.
Yeah, as much as I love collateralized lending, I think it's also a limiting factor to how much crypto can grow. At some point, we have to crack portfolio margin in this space for more than perps. At some point, we have to actually. It's not really credit. Like we collateralize credit. There's no credit risk, right? Like you have risk on your collateral, but you're not evaluating your counterparty. At August, we do a bunch of OTC lending. We provide the tools, and I think DeFi, being on a blockchain alone, is still 90% cheaper to operate a financial firm. By virtue of the fact that the loan is on chain, you can inspect the counterparty in real time. Issuing the loan is programmatic. You don't need to deal with layers and layers of paperwork. And you can implement blockchain level transaction approval policies to control what your counterparty does with the funds. And so at August, basically, if I borrow $1 million and tell people that I'm going to buy ETH with it, I lose admin control of my account. The admin control goes to my lender. And so if I try to buy some other coin that's not Ethereum, the transaction failed. And so we're trying to push in that direction to enable more and more credit. And at some point, we're going to have to do that. And the hope is that you put more of the credit on the blockchain and migrate the traditional financial rails onto the blockchain. Yeah.
Kirk, Charles, quick thoughts on it, like 19 seconds.
Just a final thought is there's an arms race between under-collateralized lending and tokenization, right? And so the question that I would encourage you all to think about is what are the interesting asset classes that can be readily tokenized? And in general, that's things that are more fungible, right? Like not your house, but like ETFs. But there's a lot of things, 99% of the world's assets are not there yet, but they're coming soon.
Any quick last thought from you? Well, okay, thank you so much. We're over time. Hope this was helpful. Thank you.
Thank you.
Thank you.